The markets are reacting negatively to moves by the Federal Reserve. So this week there was discussions about the Fed getting more aggressive with raising short-term interest rates. They've already raised it by 25 basis points. That was pretty much a non-event. The talk now is for a couple of rounds of 50 basis points increases. And there are some Fed governors that are suggesting that we should be more aggressive than that and possibly go at 75 basis points. Either way you look at it, on the interest rate front, with the short-term rates controlled by the Fed running below inflation, we're still very accommodative on an interest rate front. But this is making the market fairly nervous. In addition to that, quantitative tightening, the reversal of quantitative easing, is scheduled to begin here next week. And the Fed has announced that they will start to shrink the balance sheet by about $85 billion a month. And we'll see if this really occurs. A brief backdrop on how we got there with the Fed. The Fed started quantitative easing back here in 2008 during the financial crisis. And you can see that that was occurring at that point in time. And the Fed eased aggressively, was buying treasuries, this big blue area, they started buying mortgage-backed securities, all to help the economy and the sluggish recovery. And then we continued to move forward, and the Fed continued to do quantitative easing up through 2011. And here in 2011, there was some discussion about quantitative tightening and stopping the quantitative easing program. That did not occur. We had the event that was called the taper tantrum, where the markets, especially bonds, sold off hard, and the Fed, as you can see, did not follow through with quantitative tightening at that point in time, and then actually announced another round of quantitative easing, which accelerated here at this point in time. I dubbed it Qfinity at the time. The Dallas Fed Chairman Fisher called the event the Hotel California moment, where we can enter the hotel. You can enter the Hotel California, but you're never going to be able to leave quantitative easing if you don't start now. And clearly, we had another ramp up, and then we got out here into 2018, and at that point in time, the Fed did start another round of quantitative tapering, and we were having modest success with that. And then, of course, COVID hit, and we had a very big round of quantitative easing where the balance sheet basically more than doubled. We are now up to $8.9 trillion on the Federal Reserve balance sheet. This is more than double from where we were, back in late 2019, pre-COVID. And then if we go back to the financial crisis, we were actually at around an $800 billion balance sheet back here. So over the course of 14 years, we have had our balance sheet go up by 11-fold for the Federal Reserve. Now, the balance sheet increases, as you can see here clearly, is just putting more liquidity, more cash into the system. And as that occurs, the cash is used not only for economic activity and helping people buy goods and services, but it's also gone into financial assets. So, the stock market has been in a boom up until recently. Since the Fed started quantitative easing, and it did it for almost 14 years. And we've had a very big boom after COVID when the Fed doubled its balance sheet. The stock market has surged. Unfortunately, at this point in time, all of this Federal Reserve increased cash, increased liquidity, chasing assets, stocks, real estate, cryptocurrencies, and it's even spilled into the silly NFTs. We've seen a very big move in asset prices. That is going into the real economy now, and you're seeing inflation uptick here in the United States, and that uptick is from a couple of areas. First, we have this massive liquidity, and so there's more dollars chasing a limited number of goods and services, and that causes price inflation, and we do think that is going to be with us for a while. The other item where we've had shortages. So first we had the shortages in semiconductors, and that spilled over into car automotive. So there's been a shortage of cars here over the past little over a year. That does seem to be easing a little bit at this point in time, but car prices and used car prices have gone significantly up since then. We've also seen a big increase in rents. Rents are running at 15% higher year over year. That is a huge number to take a look at on the inflation front. We are now faced with an additional dilemma in that the Russian invasion of Ukraine is going to put additional shortages into the energy sector, metal sector, and also into the food sector. So this is going to be a very big negative. And this is the type of shortage, a supply shortage, that's different than the inflation caused by the Federal Reserve. So the inflation caused by the Federal Reserve is because there's too many dollars. The inflation that's going to be caused by these shortages is going to be because there's not enough supply, even though the demand may stay the same, or actually is probably going to go down as price increases to handle the shortage, offset, and help dampen demand. So those are two very different mechanisms for inflation. The one is historically the basis of a tight economy. This one's very unusual in that it's caused by this major disruption, this humanitarian disaster in the Ukraine that we're watching. Very negative on a humanitarian basis, but also is going to have a very negative impact on inflation. The food issue is especially important in that Ukraine and Russia were big exporters of food. We are already pushing limits as far as food security for much of the globe, especially the developing world. We potentially are going to have some big crisis there. In addition to that, natural gas, which is used to make fertilizer, which is a big input and increases production of agricultural crops. That is seeing a potential limitation. So, there's a very real chance that we're going to have some shortages in various fertilizers. And also, Belarus is a big exporter of some fertilizers as well, and they are also seeing these sanctions. Here in the United States, from an energy front, natural gas front, we have seen some policies that have limited the ability to increase supplies here over the past few years, both on a strict regulation, licensing, but also on an environmental front. Not saying that some of the actions don't make sense from a longer term, but it's catching us a very bad time given the shortages coming out of the Russia that are going to help push up prices for energy, natural gas, and your gasoline, which you can see at the pump has surged here recently. That fix is going to take a longer time to actually address. It takes a year or two to go from identifying a site, getting the permitting, and actually turning that into production. So while we're going to see a modest uptick in U.S. production here, it's going to take a while to actually get back up to the levels we were at. And we're actually going to be increasing our exports So we're not only going to be using it ourselves, but we're going to be exporting to the world, including Europe, as they try to wean themselves of Russia crude and natural gas. So all told, we've got a lot of pressures on inflation. The Fed is the first creator with this massive balance sheet increase. This balance sheet increase is coupled with, crazy amounts of debt, federal debt, deficits running. We're up to, $32 trillion in debt. That's on versus a $24 trillion economy. We also have major unfunded liabilities for Social Security and Medicare. The estimates on those are around 25 trillion and 30 trillion respectively. These are liabilities that have been promised to people but have not been paid. All those things are going to continue to put pressure on the federal deficit. The deficit cannot be reined in here at this standpoint. You cannot raise taxes enough to rein in the deficit without killing the economy. The free spending ways are going to be coming to an end pretty shortly. The only opportunity is going to be for the Federal Reserve to continue to finance the U.S. federal debt and continue to increase its balance sheet. So although they've announced they're starting quantitative tightening, as the deficit continues to run out of control and private buyers, the public, are less likely to want to buy bonds at less than inflation, the Federal Reserve is going to be one of the few places where you can actually see a take of these bonds and a financing of the government. Here again, that just feeds upon itself and will continue to make inflation worse. So we are in a relatively difficult point in time. The Fed has gotten itself boxed in, or it's entered the Hotel California, which there's really no way out of now. So inflation, in my opinion, is a secular event. We saw the bottom of inflation during the middle of the COVID crisis, and we are now starting to see a secular inflation move that will probably last at least 5 or 6 years and maybe a decade or more, depending on how fast we liquidate and adjust. The other item to keep in mind is one of the unintended consequences of sanctions that the U.S. put on Russia and the Western world put on Russia is that when they started pushing Russia out of the dollar system, other countries have taken note, and the utilization of the dollar as a reserve currency is going to go down, given the reserve currency was not honored for the Russians. And this is going to be a move that causes more dollars to be recirculated back in the U.S., as these foreign entities do not need this for trade. This is clearly a big long-term negative for the strength of the dollar and inflation here in the U.S. So stay cautious. The market has only began to react. Interest rates, in my opinion, will continue to move dramatically higher as the markets and adjust to higher inflation. Clearly, you don't want to be buying bonds that are lower than the inflation rate. So stay cautious. Interest rates are heading up. That should compress PEs here. And if the Fed actually follows through with some liquidity decreases here with quantitative tightening, we could be in for a rough period in the stock market. This is information we think you should find helpful. Please remember, it's not investment advice, and we do follow this with our own portfolio, but you have to look at your own particular circumstances to decide whether this makes sense for you. Please take a look at our website, buildingbenjamins.com, where we have our full disclaimer, and also we have additional information. We have a full written report on this as well, in case you want to see more charts and graphs. and explains this in greater detail. We also have individual stocks that I own in my own portfolio where I talk about the logic behind these investments. So please have a great day, and thank you for your time.